the disposition of capital assets. Obviously, what we're talking about here is the sale, the disposition of assets that qualify as capital assets. Now, we'll start here by looking at disposition first, the sale of property, because whether it's capital or not, we've got some questions that we have that arise anytime we have the sale of property. We're going to have to understand and make certain we can assess the character of the gain or the loss, the amount of the gain or the loss, and the tax treatment of that gain or loss, when it's going to be recognized for tax purposes. Okay, is it going to be now? Is it going to be later? When is it that that gain or loss is going to be a tax issue? Now, connected to the disposition, we'll get to capital assets here in just a minute, but connected to disposition, we've got three amounts that we need to be familiar with what it is that they actually represent. The amount realized is from a sale or trade of property, is everything that's received by the seller for the property. So this is money, any other property services that are received, the value of debt or other liabilities that the buyer of the property assumes. Okay, that's the amount realized. The realized gain or loss is the difference between the adjusted basis of the property and the amount that was realized in the transaction. Okay, the difference between the adjusted basis and the amount realized is the realized gain or loss. And then the recognized gain or loss is the amount of the gain or loss that's recognized for tax purposes. Okay, the amount that's recognized for tax purposes during the tax year. Okay, so those are the questions that we're going to be looking at. Some transactions are going to move that gain or loss into the future. The gain into the future may get deferred, but when the amount realized, the realized gain, the recognized loss, and the questions we have, the character of the gain or loss, the amount of the gain or loss, and when it is that that gain or loss is how it's going to be treated for tax purposes. So that's all asset disposals, asset dispositions. What we're interested in specifically right now are capital assets, and we'll look at other assets, other transactions later, but here we're looking at capital assets. So the foundation of capital assets is to understand what is classified as a capital asset. So we need to know what's going to generate a capital gain or loss. And so what we've got here is a list of what is capital assets. Now, the way it's given originally is that capital assets include all investment property and property held for personal use except for these things. Okay, inventory is not a capital asset. Depreciable or real property used in a trade or business is not a capital asset. Intangible assets like patents, inventions, secret formula or processes, copyrights, artistic, literary compositions are not capital assets. Accounts or notes receivable from normal business activities is not a capital asset. Supplies used in a business, not a capital asset. U.S. government publications acquired for free, not a capital asset. Okay, these are the items that are not capital assets. So all investment property and property held for personal use, except for these items, are capital assets. Now, that's kind of a weird list because it's exclusionary. So what we have here is a list of what are specifically capital assets that you need to make certain that you remember. You need to be able to identify these items on the exam as capital property. So, all investment property, this includes real estate and stocks or bonds held as an investment. Property held for personal use, cars, personal home and household furnishings, electronics, coin or stamp collections, gems or jewelry. Okay, the big ones here, personal home. Personal home is a capital asset. Investments, stocks, bonds held as an investment, capital asset. Real estate held as an investment, capital asset. Okay, those are the ones that show up most often, but your personal home is a capital asset. Now, in addition to knowing what is a capital asset, we also need to know the holding period for capital assets, because the holding period determines whether it is a short-term or a long-term capital gain or loss. And here's the rule. More than 1 year is a long-term capital asset. 1 year or less is short-term. Now, when it says more than 1 year, it means more than 1 year. Not exactly 1 year. more than 1 year. So it needs to have been held for 1 year and 1 day in order to be a long-term holding. Now, this short-term versus long-term is important because short-term capital gains are taxed like ordinary income. And we'll see that long-term capital gains might have a lower tax rate. Okay, short-term capital gains are taxed like ordinary income. But when the taxpayer has these capital sales, each one gives a capital gain or a capital loss. And we have to classify each one as being a short-term or a long-term holding. So then what the taxpayer is going to do is they're going to net together the short and the long term. Okay, so all short-term gains and losses are net together, and all long-term net gains and losses are net together. If both gains, or if they're short-term and long-term, are both gains or they're both losses, I had to get that out right. Okay, if all of our short-term, if our net short-term capital gain, long-term capital gains are both gains or losses, they are treated as their time period of holding. So it'll be a short-term and there'll be a long-term. But if they're different, they're going to be net together, and we'll look at this in a table. But we're going to, if we have short-term capital gain and long-term capital loss, those are going to get net together and treated as the time period of the larger amount. Okay, so we've got a little table here. If we have a short-term capital gain and a long-term capital gain, short-term is ordinary income, taxed at ordinary income tax rates. Long-term is capital, and it is taxed at capital tax rates. If they both have losses, short-term, long-term losses, short-term is ordinary, long-term is capital. But if it's a short-term gain and a long-term loss, or a short-term loss and a long-term gain, okay, short and long-term are different, they get net together, and the net amount retains the time period classification of the greater amount. So if we have a $100 short-term gain and a $50 short-term loss, that becomes a $50 short-term capital gain, and because it's short-term, it's taxed as ordinary income. Okay, it's taxed as ordinary income. Now, if it had been a $50 short-term gain and a $100 long-term loss, then we would have a $50 long-term loss. Okay, when they're different, we net them together, and whichever of those two amounts is bigger, that's the classification of the time period. Now, the next thing that we need to look at, and this is going to be something that's tested, is how it is that capital gains and losses are treated for individual taxpayers and how gains or losses are treated for corporate taxpayers. So we need to look at this for individuals, and we need to look at this for corporations. So for individuals, the rates that apply to a net capital gain are generally lower than the tax rates that apply to other income. So long-term capital gains receive a special tax treatment and are generally taxed at a maximum rate of 20%. Okay, now there's a couple of categories of long-term capital gains that are more than 20%, but generally long-term capital gains are taxed at a maximum rate of 20%. Short-term capital gains are treated as ordinary income. So there's no special treatment for a short-term capital gain, but a long-term capital gain is generally going to be taxed at a lower rate than ordinary income. So that's the treatment of capital gains and how it's taxed. For individuals, if there is a net capital loss, individuals can deduct from their income the lesser of $3,000 of net capital loss per year, $1,500 if married filing separately, or taxable income. Okay, the lesser of whichever is smaller, $3,000 or taxable income. So you can't create a tax loss out of this. Okay, you can't make a tax loss out of your capital loss. You cannot carry capital losses back to prior years, but individuals can carry capital losses forward indefinitely to be used against future income. So if you had $8,000 of capital loss this year, you can only use $3,000 of it this year. But that other $5,000, you can carry it forward and use it to offset ordinary income or capital income, capital gains in future periods. Okay, so net capital losses, $3,000 or taxable income, whichever is smaller for individuals. Now, corporate capital gain and loss. Well, corporations do not receive a reduced tax rate for capital gains. Okay? They can deduct capital losses only to the extent of capital gains, but they can offset a net long-term capital loss against a net short-term capital gain. And corporations can carry a net capital loss back 3 years and forward 5. Now, why are individuals and corporations different for this? I'm sure there's a reason other than to make it more difficult for you. Okay, but individuals cannot carry back, can carry forward indefinitely. Corporations can carry back 3 years and forward 5 years. Okay, and the carry forward, carry back is always treated as a short-term capital loss. Okay, when they move it to another period, it's still a short-term capital loss. And corporations are reporting capital gains and losses on Schedule D and Form 8949, just like individual taxpayers are doing. So that's standard capital gain, capital loss. We need to know what is a capital asset. We need to know short-term, long-term, what that holding period is. And we need to understand how individuals and corporations are able to deal with a capital loss. And then there's a tax benefit for individuals with a capital gain. It's taxed at a lower rate than ordinary income. That's the standard capital tax issue, capital assets, sale of capital assets. Now, I set all that up as standard because we've got something else that may give us a capital gain or loss. And we're looking here at the sale of business, tangible, personal, and real property. This is called Section 1231 property. It's land or depreciable property that is used in a trade or business. These are not capital assets, but they may give rise to gains or losses that are treated as a capital gain or loss. Okay? So it's not a capital asset, but it may give us a capital item. If Section 1231 losses exceed the gains, then the net losses are treated as an ordinary loss. But if Section 1231 is a net gain, some of that capital gain may have to be recaptured, reclassified as ordinary income. So a total gain in Section 1231 property is going to have two parts, a capital gain and an ordinary gain. And we'll talk about this and we'll show it in an example with numbers that I think will really help kind of put this theory into understandable for you. But we have an issue of this reclassification of gain. We've got two subsections of 1231 property that may have to have their gain reclassified as ordinary income. We first have what is called Section 1245 property. This is essentially depreciable personal property. Okay? Section 1245 property, personal property. The gain on the disposition of Section 1245 property is treated as ordinary income to the extent of the depreciation on the property, which means that any gain that's recognized that is more than the part that's ordinary income from depreciation is going to be a Section 1231 gain. Okay? We'll come back to this. Section 1250 property is depreciable real property, and all gain due depreciation greater than straight line method is recaptured as an ordinary gain. So, we're talking here about a recapture. The result of the recapture is that the company will have a capital gain that's equal to the amount of increase in the value of the asset while they held it. Okay, and the amount of their capital gain is the value, the increase in the value of the asset while it was being held. So the difference between what they paid for it and what they sold for it. Now, we know that depreciation is going to decrease that original basis. So the gain on the sale that they have because of depreciation is going to be taxed as ordinary income. And so what that means is the capital gain is only the amount of the gain that results from the property appreciating in value. Not because they depreciated it, but because it actually appreciated in value. So let's go ahead and look at some examples here, and hopefully with these examples it'll kind of build this in your mind what it is that's happening. Assume a company owns Section 1245 property that costs $500 and has $310 of accumulated depreciation. So the adjusted basis of the property is $190. Okay, that's our adjusted basis. If the property is sold for $600, what gains and losses do we have? Well, there is a total realized gain of $410. Okay, this is just what we had. So we sold it for $600 it had an adjusted basis of 190. Now, the question we have is, how much of that gain is going to be ordinary and how much of that gain is going to be capital? So the amount of depreciation that's been recognized is going to be treated as ordinary income, and the remaining gain is going to be treated as a Section 1231 gain, which is a capital gain. Now, if we just look at this situation, they bought it for $500, they sold it for $600. That's a $100 gain. You bought it for $500, you sold it for $600. Remember, depreciation is just kind of this mathematical allocation. So when we sold it, the basis of the property was $190. So we had $310 of gain that really wasn't gain, but it was the recovery of that depreciation expense. How was that depreciation expense classified? Ordinary expense. And so the gain that came about because of that ordinary depreciation is going to be recognized or classified as an ordinary gain. The amount of the gain that has to do with the fact we paid $500 and sold it for $600, that is what is going to be the capital gain. Now, the second situation here, owns Section 1245 property that costs $500, has $310 of accumulated depreciation. Again, adjusted basis $190. If the property is sold for $400, what are the gains and losses? Well, there's a realized gain of $210, but the only reason we have a gain is because of depreciation. If there was no depreciation, we bought it for $500 and we sold it for $400. That's a loss. That's a loss. Because of the depreciation, we had a $210 gain on the sale, but the only reason we have that $210 is because we had depreciation. Okay? So the company's going to have, in total, $100 of loss because over time they had $310 of depreciation expense in their tax return, and now they only have $210 of gain, ordinary gain. So if we take all their tax returns connected to this piece of property, there's $100 of expense in total, which makes sense because they bought it for $500 and sold it for $400. So this whole thing of reclassification, just kind of don't worry about the theory. Maybe I shouldn't even present that. It's just the numbers. You bought it, there was depreciation, you sold it. The amount of that gain that's connected to depreciation, that's ordinary. The amount of gain that you bought it and sold it for more, that's going to be capital. Okay, get into 1231, 1245, 1250, just these examples. This is going to help you get through this in terms of why it is that some of that gain is ordinary and why it is that some of that gain is capital. So we've looked here at capital property. Okay, what it is, how it's classified, what time period it is, what we can do with the gains, what we can do with the losses for individuals and corporations. That's capital assets. What we also need to look at, and we'll look at that separately, is disposition or other dispositions of property. Not a capital disposition, but other types of property, and we'll do that separately. And also virtual currency transactions. We're talking here about cryptocurrency, Bitcoin, becoming more and more common. A transaction involving virtual currency includes the receipt or transfer of virtual currency for free, an exchange of virtual currency for goods or services, a sale of virtual currency, an exchange of virtual currency for other property, including other virtual currency. And so for income tax purposes, virtual currency is treated as property, and general tax principles applicable to property transactions apply to transactions that are involving a virtual currency. So, whole lot of things there, a lot that we've gone through, again, all minor. And as I said, most taxpayers aren't going to have many of these, if any of them at all. But these are all things that if we are involved in illegal activities, if we have gambling winnings, if we have hobby income, all of these are items that are going to be included in our income if we have them.